Hello, everyone. Welcome back to Hard Money Jim. I want to talk about the soaring price of precious metals, gold and silver. But before I do, I need to set the context. Now, here at Hard Money Jim, we're all about money creation and its consequences. What does money creation have to do with investing in gold and silver? We need to be sure that this connection is very clear. So here's a condensed version of my thesis, which I spell out in detail in my book, A Black Hole in Economics. So here's the broad context. Western economies led by the USA are stuck because of their runaway sovereign debts. Unmanageable spending on mandatory programs like Social Security and Medicare, along with rising military costs and increasing interest costs on growing debt, all these have created huge and growing annual budget deficits. And these deficits ensure that the debt and interest payments keep expanding. In addition to these existing debts, Western governments have made unpayable future promises to their citizens. And these financial obligations are now a structural part of our economy and our government. The only way to reduce these debts without defaulting on political promises, which I believe would ignite serious civil unrest, is through a policy of continuous monetary inflation, which gradually decreases the value of these debts by devaluing the dollar. For details, you can see my book. So this is the economic era we live in. For savers and investors, the primary consequence of irresponsible money creation is that it is now crucial to hedge against losses in your dollar-based wealth by investing in precious metals, particularly gold. So that's why we need to talk about gold and silver today. Okay, with that said, what on earth is happening with the prices of the precious metals, especially gold and silver? You can see the upward trend on the far right there in this chart. As of today, October 4th, gold is nearing $4,000 per ounce and silver is approaching $50 per ounce. And their recent price increases have been really almost astonishing. Now, as shown in this chart from Bianco Research, the 45% rise in gold prices year to date for the first 9 months of this year is second only to the increase that we saw in 1979. Now, that year, gold went up 65% in the first 9 months and 132% for the entire year. Gold peaked in 1980 at around $850 per ounce and then entered a years-long bear market. So we have to ask, could 2025 be a repeat of 1979, indicating the start of a bull market blow-off followed by a bear market? So we're going to discuss that possibility. The gold price was particularly strong in the month of September, possibly anticipating the Fed's decision to cut the funds rate by 25 basis points on September 17th, which indicates that the metals markets are sensing increased consumer price inflation, perhaps in the near future. Surprisingly, the mainstream financial media have remained fairly quiet about precious metal prices, despite these recent dynamic price movements. For example, they'll talk endlessly about why you should own the Magnificent Seven tech companies, but they say almost nothing about owning gold. I think there's more at stake here than just a simple desire to hedge against rising consumer prices. In Chapter 8 of my book, which, by the way, is nearing its 1-year publication anniversary on November 1st, I strongly recommended owning gold and other assets that will retain their value during inflation and periods of a weakening dollar. I've also promoted and discussed gold extensively in my Substack and YouTube videos over the past 3 years. But given the recent extraordinary price jumps, I think you deserve some comments, even though these rapid price movements are actually a little hard to explain. So today I want to share with you what I know. So I'm going to present you with a collection of related facts about the gold and silver markets, along with some insights from many smart market analysts, and then offer a clear interpretation of those facts. In short, it all points to a very bullish setup for gold and silver. Despite the recent sharp rise in the price of both metals, I think it's not time to get off the gold train. And I remain very optimistic about the metals as well as the mining companies that extract these metals from the ground. First, we'll review the recent breathtaking price action. and offer some reasons for the price surge by identifying where the demand might be coming from. And next, we'll ponder how high the price of gold and silver might go by consulting some of the well-known commentators and economists and analyzing today's moves in light of past moves. And finally, I'll offer some general guidance and suggestions on what you should do with your gold and silver holdings if you own them, and address the question, if you do not already own gold, is it too late to get started? And how should you do that? So why is the gold price rising so fast? What are the demand factors that could account for this kind of rapid increase? Now, as a first cut, we should mention the generic, almost intuitive reasons that most people give for holding precious metals. And these are inflation concerns, expectations of lower interest rates, and geopolitical concerns, all of which make gold more attractive relative to bonds, say. Jim Grant of Grant's Interest Rate Observer has a famous quip that sums up these kinds of reasons. Quote, "Gold, say we, is not so much an inflation hedge as an investment in monetary disorder." And that's what he said. And there's plenty of monetary disorder going around today, right? But let's dig a little deeper now and look at specific sources of demand. Who's buying gold and why? Now, the most fundamental demand comes from central bank buying. Many monetary authorities, mostly central banks, but also related entities like sovereign wealth funds, sovereign treasuries, and in the case of China, the People's Liberation Army, have stopped adding to their holdings of U.S. treasuries. And instead of using their trade surpluses to purchase treasuries as a safe place to store their profits and surpluses, they're buying gold. In other words, when they're looking to cycle their dollars into a safe liquid asset, also known as a reserve asset, they are increasingly turning away from dollar-denominated bank deposits and treasury bonds and allocating more to gold. Foreign central banks, especially those in Asia, have been doing this for years, and they continue to buy gold, remaining price insensitive. In other words, they keep buying even as the gold price rises without seeming to care about the price at these levels. So Bloomberg and other analysts have reported that gold has now surpassed central bank holdings of treasuries as a reserve asset, and they're reporting that gold has become the reserve asset of choice for many central banks, especially the Asian banks. The dollar remains the world's most used currency for transactional purposes, but as an asset used to store value, it seems we're at a tipping point where gold has become the preferred asset for central banks to store value. And that's as shown as in this chart here that shows that central banks now own more gold than treasury bonds. So, measured in dollar value, central banks now own more gold than treasury bonds. Gold is becoming the reserve asset of choice. China is both the biggest producer and buyer of gold. The Shanghai Gold Exchange, which is a subsidiary of the Chinese Central Bank, this Chinese Central Bank is called the People's Bank of China, or PBOC, is becoming a central gold market, and it aspires to be the world price setter. Chinese savers are big gold buyers. So why are foreign monetary authorities slowly moving away from U.S. treasuries? Well, first, because the dollar's value is under pressure due to frankly, our money printing. Second, the U.S. government has used treasuries as a tool of coercion, most notably against Russia because of the Ukraine war. And many countries believe that the same thing could happen to them if they don't comply with U.S. foreign policy. The U.S. government forcing its trading partners to invest their surpluses in the USA could also be a reason for wanting fewer dollars. Now, this policy is similar to currency control. It says you can only spend your dollars on what we allow, like building a factory in the USA. Now, who wants money with strings like that attached to it? This policy amounts to a soft confiscation of our trading partners' surpluses from past years. And if I were them, I would stop holding all my profits in dollar-denominated assets. So let's examine central bank gold purchases with a focus on China. Why are central banks buying gold? Because gold is recognized as money, or as easily convertible money, in every economy worldwide. Due to this widespread acceptance, gold exists outside the control of any monetary authority or political power. That's why gold is called a neutral reserve asset. No nation is powerful enough to fully ban gold without risking a major public backlash. The USA can easily shut down the bank accounts of its adversaries, but no one can shut down gold. Moreover, the fact that major economies like China, Russia, and India are acquiring gold and using it for international payments makes it crucial for everyone to recognize gold in some significant way. Now, China has encouraged its citizens to own gold for years, and gold has provided them a good hedge against China's asset bubble economy. As people suffer from the collapsing values of overbuilt real estate, they at least have a rising gold price as an offset. If the PBOC ever has to devalue the renminbi, gold will offset that loss of wealth. So the widespread interest in China promotes and legitimizes international gold and vice versa. China is clearly planning for the dollar to lose value. They're trying to corner the gold market, meaning they want to own and control enough gold to significantly influence its price. They have opened the Shanghai Gold Exchange to foreigners who can now trade directly without needing to establish a Chinese subsidiary. The Shanghai Gold Exchange is establishing gold vaults in places like Hong Kong and Saudi Arabia. And you note that these are countries with an export surplus to China. So take Saudi Arabia, for example. Saudi can sell oil to China in China's currency, the renminbi. Then they can buy gold with the proceeds, store the gold in a vault in their own country. Then they can use this gold as collateral to borrow renminbi from a Chinese bank, then use the borrowed renminbi to invest in China or to hire Chinese contractors to build infrastructures in Saudi. The Chinese promise always to exchange renminbi for gold at market prices and vice versa. Using gold as collateral for loans or repurchase agreements in renminbi is a good way to increase the use of renminbi in commerce. So you can use gold-backed loans to circulate more Chinese currency. I understand this model is also being used in Africa as part of China's Belt and Road program. According to Bloomberg, the People's Bank of China is using the Shanghai Gold Exchange to attract central banks from friendly nations to buy bullion and store it inside China's borders. The goal is for Beijing to become the custodian of foreign sovereign gold reserves, and as the U.S. once was for European countries. This is bigger than just private gold storage. It's about building the architecture of a global trade settlement in a system that moves away from the dollar and that brings gold back into the center of the global monetary system. Custody of sovereign gold has long been concentrated in Western centers like London, New York, and Zurich. If China succeeds, Shanghai will become an alternate hub, signaling a major realignment of the global monetary order. And now, to sum up this point, central banks are already buying record amounts of gold as trust in U.S. Treasuries fades. China, the world's largest producer and consumer of gold, is positioning itself to turn those flows into a geopolitical advantage and position gold as a neutral reserve asset over which they will exert control. Okay, so I think that gives us a pretty good look at the major sources of demand for gold, which are central banks. Let's take a look now at how high the gold price could go. And as a first step, we could examine price movements in previous gold bull markets. And you can see in this chart here, I asked Grok to construct a graph of the average annual gold price since 1971, placing the price axis on a logarithmic scale so you can see the proportional movements rather than dollar prices. There have been 3 previous bull markets in gold since it became freely priced in dollars back in 1971. In the early 70s bull market, from trough to peak, the gold price went up 5.6 times. In the late 70s, trough to peak, the move was 8.2 times, peaking in 1980 at $850 per ounce, which remained an all-time high for many years. Now I'll explain why I think gold went down and stayed down for so long in the post-80s bear market. On the graph here, in the early 2000s bull market, the move from trough to peak was 7.9 times. If we take the 2015 price of $1,015 per ounce as the low point in the present run, history implies a peak price of $6,000 to $8,000 per ounce in this current cycle. Of course, we don't know for sure if this cycle will mimic past patterns or how long the cycle will last. And this type of analysis relies on a repeat of the kind of human behavior we've seen in past market cycles. And this seems plausible, but remember, it's never guaranteed. I will say without exception, the major investment banks are all saying the price is going to go much higher, and they're raising their target prices regularly. And as these target prices are reached, they keep raising estimates based on continued demand. Now, understand, these investment banks are positioning their institutional and high net worth clients based on the worldwide demand patterns that they are seeing from their trading desks. They have proprietary worldwide market information, and it's not in their interest to sell a product that will crash in price, so I take their price targets seriously. As some examples, JP Morgan recently raised its target gold price to $4,200 by year end this year, and to $6,000 by the end of 2029. Goldman Sachs has a $5,000 near-term target. UBS just raised its silver target to $44 to $47, but silver's already exceeded $47 per ounce. Lately, the prices of the metals seem to rise faster than the banks can revise their targets. Now, what about other metrics and benchmarks that we could use to estimate future prices based on historical price action? A few days ago, analyst Chris Wood from Jefferies Capital reaffirmed his long-term gold framework, noting gold would need to reach about $6,600 per ounce to match its 1980 peak share of U.S. disposable income. The report highlighted gold's advance from $3,700, but frames $6,600 as a secular benchmark, not a trading target. Gold Fix, a trading service I recommend, applies a similar method, calculating an increase in the gold price that's proportionate to the increase in U.S. M2 money supply, which implies a price rise to about $12,000 per ounce. I'd note that this divergence in estimates, 6,600 to 12,000, highlights the gap between household wealth and institutional wealth. In other words, the gap between investable liquidity of households and that of large financial institutions. Both households and institutions are potential sources of demand for gold, but obviously, financial institutions have way more financial firepower. Now, Michael Howell, who writes a Substack letter called Capital Wars, and who, in my view, does the best research on worldwide liquidity, which drives the prices of financial assets like stocks and Bitcoin and gold, estimates a price of $10,000 per ounce based on the historical relationship between worldwide liquidity and the gold price. In other words, rising liquidity is pushing up the gold price. Alistair MacLeod of MacLeod Finance predicts a significantly higher gold price based on similar reasoning. He estimates global investment assets of $300 trillion, with gold holdings at current prices making up roughly 0.5% of that. As fiat currencies continue to inflate and devalue, and as gold becomes more popular, gold's percentage of these total assets will need to increase. And this will lead to a higher dollar price of gold, even as the dollar value of other financial assets may decline or stagnate temporarily under a market crash. Alistair does not specifically target a particular price. He only states that the increase in gold prices will be explosive. Now let's benchmark gold against equity values. This chart shows the ratio of the market cap of gold to the market cap of U.S. equities. Market capitalization is just the total value of the asset class at current prices. For example, the market cap of gold is all the known tons of gold in the world times its latest market price. The median ratio, measured this way, is 40%, as you see. But you can see that during wars, currency crises, and financial crises, the ratio rises to 3 or 4 times the median. So if the world is headed for a crisis, this reversion trade has barely begun, and the gold price could soar even as equities decline. If you own gold, you'd like to see a higher price, of course. Does the U.S. government want a higher gold price? It's clear that the U.S. government would benefit from owning more gold at a higher price. The Treasury Secretary, Scott Bessent, has promised to use U.S. government assets to alleviate the U.S. debt burden. If the USA is going to use its 8,133 tons of gold as collateral to borrow cheaply, it'll want a higher gold price, and it'll also want to own more gold. Acquiring more gold could even help boost the price. So note that the U.S. is not charging tariffs on imported gold or silver. Why? Because you don't tariff what you want to be in your country. And if you want it in your country, presumably you would like a higher price. So although this is conjecture on my part, it's possible that the U.S. Treasury is acquiring more gold and silver in anticipation of using it to help pay down debt. As the price of the metals rises, gold will likely have a place in U.S. government financial policy. The economist Judy Shelton has said that Trump promised her that the Treasury would issue a gold-backed Treasury bond in 2026 at the 250th national birthday. So I guess we'll see. Now, we've been talking mostly about gold, but we should not neglect the other monetary metal, silver. The silver price has been storming ahead, as you can see in this graph. It's been outperforming gold recently. Michael Oliver, a veteran metals analyst and a market technician, says silver is, quote, entering a new price reality, and it'll easily reach $52 and could eventually go to the $140 range. There is a U.S. government proposal to declare silver a strategic metal. The U.S. needs it for military and industrial use and considers it important to have adequate stockpiles in case of some international disruption or incident. This is obviously bullish for the silver price. Silver as a strategic metal implies a government-set price floor. According to the analysts at GoldFix, silver's dual role as a monetary hedge and as an industrial input means that supply interventions could create tighter markets, particularly if stockpiles or joint purchasing agreements between government and private industry emerge as policy. The practical effect of a strategic stockpile is to skew prices higher while minimizing downside volatility, as the U.S. would hold off supplies from the market to maintain strategic stockpiles. Now, some commentators have observed a similarity between today's gold market and the one in the late 1970s, which I mentioned at the start of this talk. So the question is whether this bull run that we're in right now resembles the late 70s, indicating that we might be nearing a peak in gold prices. So let's revisit our chart now of gold prices since 1970. And remember that gold has only traded freely in dollars since August of 1971, when President Nixon ended the dollar-gold exchange rate of $35 per ounce. Now, gold then climbed, meaning the dollar devalued against gold, dramatically until the late 1970s, when the price surged even more dramatically. The gold bull market ended abruptly in 1980, when the Federal Reserve, led by Paul Volcker, sharply increased interest rates to fight soaring CPI inflation, which had peaked at 13.5% that year, 1980. The Fed funds rate hit 20% in early 1980, strengthening the dollar and making non-yielding assets like gold less attractive. And just think about it, with nominal interest rates at 20% and real rates around 10%, I too would prefer T-bills over gold. This sharp policy change quickly crushed demand for gold as an inflation hedge, and the gold price fell pretty rapidly. So the question is, could the Fed do the same thing today? I believe not, because raising short-term rates above the inflation rate isn't feasible today. In the late 1970s, the U.S. debt to GDP ratio was approximately 30%, making Treasury interest costs manageable relative to the Treasury's ability to pay them. Back then, the government had the capacity to borrow to pay Treasury holders much higher interest rates. But today, with a debt to GDP ratio over 100%, and increasing rapidly, by the way, raising interest rates would escalate interest costs and quickly worsen the already out of control deficit, potentially wrecking the Treasury market. In other words, the U.S. Treasury simply cannot afford higher interest rates today. This makes aggressive rate hikes, which would be required to make bonds competitive with gold and curb inflation. That makes these kinds of rate hikes very unlikely. Raising rates enough to kill inflation would also kill the economy. It would worsen the already critical deficit, and it would likely ruin the bond market. So in 1979, Paul Volcker's sudden increase in interest rates was effective in subduing consumer price inflation, which then reduced the need for gold as a hedge against inflation. However, today, inflation is built into the system because of mandatory government spending. Additionally, inflation is necessary if the government is going to gradually reduce our national debt relative to GDP. So completely killing inflation is definitely not in the government's best interest. And outright deflation would cause a major economic crisis. Therefore, even though much higher interest rates on treasuries might drive down the gold price, this won't be allowed to happen because significantly higher interest rates would quickly bankrupt the U.S. government. Unlike the late 1970s, the government is now limited in its ability to control price increases and to keep and it's limited in its ability to keep the gold price down. And that's why financial repression, which I discuss thoroughly in my book, is the necessary financial policy of the day. Now, there's also a significant difference in the geopolitical environment of the 1970s, early 80s, and now. In the 1980s, after the Iranian hostage crisis and the start of the Reagan era, geopolitical tensions began to ease, which put downward pressure on the gold price. Today, I would argue geopolitical tensions are heating up, not easing. Now, there are still other factors that contributed to the decline in the gold price after its peak in 1980. Central bank gold policy back then compared to now is completely different. In the 1980s, central banks began selling gold, and this policy continued for many years. Today, however, they are active buyers. So let's dive a little bit deeper into this. As I mentioned, the U.S. severed its last official ties to gold in 1971 under the Nixon administration. The dollar then experienced a significant devaluation, meaning the price of gold in dollars increased substantially during the 1970s, from the official $35 per ounce to its peak of $850 per ounce in 1980. However, at that time, the U.S. government was actively undermining gold as an international settlement asset. The International Monetary Fund, backed by the USA, formally ended gold's role in the international monetary system in 1978 by prohibiting members from fixing exchange rates to gold if they wanted to access IMF funds. Back to the central bank gold buying chart, between 1976 and 1980, in a series of auctions, the IMF sold around 730 tons of gold, and many central banks, including the US, the UK, the Netherlands, Belgium, and Australia, followed the IMF lead. And this mass central bank sell-off, which resumed in 1989, caused gold's spot price to decline more than 61% between 1980 and 2001. The market price bottomed around the year 2000 when Britain's Chancellor Gordon Brown sold more than half the UK's remaining gold holdings. That was between 1999 and 2002. That was the very bottom of the gold price market, and this selling action is now known as Brown's bottom. To stabilize the disrupted gold market, in 1999, the US, the UK, and several Central European countries required that their central banks limit their collective gold sales to 2,000 tons over the 5-year period, in other words, allowing only 400 tons to be sold per year. Additional agreements to limit gold sales were later signed in 2004 and 2009, which helped to stabilize gold's price and increase the transparency around central bank gold sales. The main point of this history of central banks is to show that these central bank gold sales from the mid-70s to 2009 played a significant role in keeping the gold price low. During that time, many central banks' policies were to sell gold, and they kept selling even as the gold price went down. Now, the policies flipped. Since the great financial crisis in 2009, central banks have been buying gold actively and increasing their purchases when the price goes up, which is helping to push the price upward even more. As the gold price increases, they've continued to buy more, indicating they are not sensitive to the price, at least not at these levels. Even these reported purchases shown in the graph here underestimate sovereign government demand for gold. Goldman Sachs and others have released research showing that many countries are buying significantly more gold than they report to the IMF, where these central bank statistics come from. China and Saudi Arabia are two clear examples of this sort of under-the-radar buying. It's obvious these central banks and monetary authorities want more gold. Based on their actions, we can reasonably infer that they want the gold price to keep climbing. Goldman Sachs is actually in a position to know this because its trading desk is at the center of the global gold trade. In addition to central bank buying, gold and silver are getting a pretty strong bid lately from exchange-traded funds like GLD and SLV, which are seeing strong inflows of dollars to buy physical gold and silver. So to think that the gold price is in the process of peaking, we need to have some idea of some big owner that would be selling. And I don't know who that would be. Clearly, the central banks are not selling, and neither is the world's new gold powerhouse, China. Just to hammer home the idea that this is not 1979, let's look at some other comparisons to the 1980 gold peak to see if there are parallels that should inform our investment posture toward gold. As the gold price peaked in 1979 and 1980, the dollar value of U.S. gold exceeded 100% of the value of foreign holdings of U.S. treasuries. This was a period of increasing concern about runaway consumer price inflation when interest rates on treasuries couldn't keep up with inflation, causing gold to become the preferred hedge against rising consumer prices. Investors at that time sold bonds and bought gold, eventually driving the gold price high enough to collateralize the entire foreign holdings of U.S. treasuries. Today, with gold just under $4,000 per ounce, the total value of gold is less than 20% of the value of treasuries held by foreigners. In other words, to collateralize foreign U.S. debt with gold, its value must increase by about 5 times from current levels. So what about the ratio of the value of gold to worldwide monetary aggregates? Now, I already mentioned the relationship between gold and U.S. M2 money supply. The idea is that the more money that's printed, the higher the price gold should go. That's a classic principle of monetary inflation. When we look at the broadest measure of worldwide money supply, we find that the quantity of money has increased much faster than the price of gold. Here's a very beautiful and busy chart. In 1979, the ratio of the gold price to world M3, scaled for readability here, was 0.5. Today, it's about 0.1 or 1/5 of its 1979 peak level when central banks were selling gold in earnest. Now, logically, the gold price rises as the money supply increases. However, as this analysis shows, comparing the red line to the green line during the recent gold price rally, the price has not increased nearly as quickly as the global money supply. To reach the 1979 peak ratio of gold to M3, the implied gold price would be above $15,000 per ounce. Now, this is not predictive, but it serves as one more plausible benchmark. And here's another metric proposed by the independent analyst who I respect, Luke Groman. What value of gold would collateralize foreign-held U.S. debt? In 1979, at the peak of the U.S. inflation scare, the value of U.S.-owned gold reached and briefly exceeded 100% of the value of foreign-held U.S. Treasury debt. You could say the gold price was bid up to collateralize that debt. Assuming that gold price, $850 per ounce, was a bubble peak, what gold price would be required to collateralize all foreign-held U.S. debt today? According to the analyst, Luke Groman, that bubble peak price is about $30,000 per ounce. So to reach a bubble status by that measure, the gold price would have to increase in dollars by 8 to 10 times from today's level. Again, I'm not saying that this will be the ultimate price target, but given the potential upside plus the lack of interest in gold among investors in the Western Hemisphere, and that is most dollar-based investors, gold is nowhere near a bubble level yet, and the same logic applies to silver, and it also applies to the mining stocks. So despite the sharp run-up in the gold and silver price, for all these reasons, I do not think the price is anywhere near a peak. I think the upward move has a long way to go. In other words, this is not 1979. So hang in there if you own the precious metals. And if you don't own them, it's not too late to start by dollar cost averaging in a regular savings plan. And the sooner you get started, the better. And so that's what I'd like to talk about next. Well, given this big move up in the precious metals prices, what should you do? The short answer is, I believe the easy money in gold has been made, but the big money is still ahead. The price increase has been dramatic, which often indicates a high risk of sharp declines. If that's true, gold prices should keep climbing, but they may also become more unpredictable, maybe perhaps so volatile that you may at times doubt your convictions. Goldfix describes the probable future price action as, quote, a marathon of sprints. That is a series of sharp upward moves, punctuated by sharp corrections with an upward trend over time. So let me say a few things to put price volatility in perspective, so perhaps you'll be better prepared for it. The reset of the global monetary system, which includes a decline in the dollar's value, a gradual shift away from the dollar in international trade, and upward adjustments to gold and silver prices in fiat currencies, is a process. It's not a single event or an incident. And this process will continue to unfold as the international monetary system is reshaped to account for two main trends. First, inflation caused by unpayable sovereign debts in the USA and other countries. And two, a shifting geopolitical landscape that relies less on the dollar. Central banks, governments, and the major investment banks are all leading in this change. But the average saver has yet to realize it. So don't be left behind just because you're a small investor. Some of you might remember from chapter 8 of my book, A Black Hole in Economics, I shared the parable of the two young fish who didn't understand the environment that they lived in. Two young fish are swimming along one day, and they meet an old fish swimming the other way. And the old fish nods at the two young fish and says, "Good morning, boys. How's the water today?" And they all continue along their paths for a while. And then one young fish looks at the other one and says, "Hey, what the hell is water?" So these young fish are not aware of the water they're swimming in, and neither are most investors. Most investors today do not appreciate that they acquired their investing habits in an era of expanding money and credit, declining interest rates, high and rising asset prices, and the speculative excesses that accompany this period. And these investors never noticed the strong current pushing them along from behind, and they're assuming their easy investment environment was normal. Now, as we enter a new era, they may still expect a favorable current when none will be there. And they may fail to notice that the water they are swimming in is becoming increasingly murky. The late, great Bob Farrell of Merrill Lynch expressed this problem eloquently, and I'm going to read this great quote. Change of a long-term or secular nature is usually gradual enough that it is obscured by the noise caused by short-term volatility. By the time secular trends are even acknowledged by the majority, They are generally obvious and mature. In the early stages of a new secular paradigm, most are conditioned to hear only the short-term noise they have been conditioned to respond to by the prior existing secular condition. Moreover, in a shift of secular or long-term significance, the markets will be adapting to a new set of rules, while most market participants will still be playing by the old rules. Gold and silver are experience a strong upward trend, yet most mainstream investors haven't gotten involved. And this is evident from a recent Bloomberg article. I'm showing you the headline here, that asked 4 wealth advisors what they would invest in a $100,000 portfolio. One of these advisors invests only in cryptocurrencies, which I believe is recklessly speculative because it lacks diversification. But none of the other 3 even mention gold or silver. In this chart from analyst Tavi Costa, we can ask how much longer can U.S. investors afford to sit out the gold rush? Gold reserves held by Americans as a percent of all reserves are now at a 90-year low, while the rest of the world has pushed its holding to near 50-year highs. At some point, America held over 50% of the gold reserves. That's, you can see on the graph there, back in the day. But today, we hold just 20%. Costa's view is it's only a matter of time before U.S. policymakers are forced to rethink this stance. So it seems clear that U.S. investors are badly underinvested in gold, and in my view, they do not understand the waters they're swimming in, but it's not too late to participate in the monetary reset. So how much gold and silver should you own then? For starters, I think a 10% allocation to investment portfolios would be prudent. Ray Dalio, who's the retired head of the world's most successful hedge fund and now runs his very large family office, that was Bridgewater Associates, recommends a 10 to 15% gold allocation to protect against debt-laden markets and other risks like a, quote, U.S. economic heart attack. Other well-known investors suggest even higher amounts. BlackRock, the largest asset manager globally, and Jeffrey Gundlach, the head of Double Line Investments, he's the guy known as the Bond King, both recommend investing in gold. And Gundlach says a 25% portfolio allocation is not excessive. That's the Bond King. He's supposed to recommend bonds, right? Your allocation decision is up to you, but I would avoid the mistake of putting all your eggs in the gold basket, but equally avoid the mistake of having no exposure to this important emerging strategic asset. My book, Black Hole, in Chapter 8, published near a year ago, strongly recommends gold as the go-to asset during periods of financial repression or inflation. I mentioned then, when gold was around $26 per ounce, and I firmly believe now, with the price up nearly 50%, that gold remains the fundamental asset for any savings and investment strategy in times of inflation or financial repression. And regular readers know that in my Substack newsletter, I've recommended only owning gold and silver multiple times. If you're new to this blog, I suggest reviewing my March 4th, 2023 Substack video and accompanying essay entitled Why Everyone Should Own Gold. I recently reread it, revisited it, and all the advice I offered then, when gold was about $1,900 per ounce, compared to today's $3,800 plus, all that advice still holds. If you expect further price increases in the precious metals, as I do, investing in mining stocks is a good way to leverage your gold investment. Regular readers and viewers know I recommend Fred Hickey's High Tech Strategist newsletter to help you select the best gold-related stocks and ETFs to invest in. I own physical gold and silver, and I hold shares in a number of precious metals mining and royalty companies. I've owned precious metals for decades and mining stocks for years, though I have had to wait a few years for the miners to start outperforming the metals. But it's been worth it because now they're beginning to deliver very significant returns. My total holdings in precious metals and related assets make up about 20% of my total investment portfolio, which might be a bit high for some people, but I am comfortable with this allocation due to my strong belief in gold's increasing role as an international monetary asset, which should result in a much higher price. So far, so good, and I am maintaining my positions. Now, very few investors have embraced the mining companies, even though many of these companies appear to be very inexpensive based on their present and future projected free cash flows. As I have written recently, the miners have a significant operating leverage, meaning they can increase their profit margins when precious metals prices rise. Higher margins and growing profits lead to higher stock prices. If you already own precious metals and miners, and you've participated in this big run-up, it's okay to trim some positions for prudent asset allocation so that no one position excessively dominates your portfolio. I've been doing just that with my gold mining stocks. I trim the outsized positions to manage risk, and I've taken some profits kind of out of prudence. How much to trim is a personal decision, your decision, but leave the basic strategy intact. In conclusion, now I'm going to reiterate the advice I shared several years ago in my article, Why Everyone Should Own Gold. If you're new to Hard Money Jim or just starting to invest in precious metals, I recommend, again, you read that article. I just reviewed it, and everything I said back then still applies today. In summary, what I said is this: at a minimum, buy some physical gold, then do nothing with it. Remember where it is, but forget you have it. Live without it until that inevitable rainy day when you need it. Most people will not do this, but I believe many will someday wish they had. Now, one more thing. I live here in Jackson Hole, Wyoming, and we are having a beautiful fall. The colors and the landscapes are stunning and inspirational. Years ago, I made a promise to myself that I would never again miss the fall colors of the Teton Mountains, and keeping that promise, I will tell you, has brought me a great deal of joy. So if you do nothing else, make a positive promise to do something good for yourself and start doing it today. Maybe that promise will even include regular investing in the precious metals. Until next time, keep the faith and be careful out there.